Hey everybody, it is month 21, and you know what that means? It is time to buy another stock or two or three.
And we're supposed to be excited and energetic and act interested in the stocks we're buying.
That's part of what we're doing, isn't it?
It is. We are interested. I am interested. It doesn't come off that way sometimes because the stocks we buy, and if you've been following along every month, they're kind of boring. I mean, what do we got? Like a nuts and bolts company. We've got an oil company. We've got like Goldfish, Campbell's Soup. I mean, these are not companies that you would just go, wow, that's amazing. This is great. I'm going to go tell all my friends and my girlfriend. I'm going to bring them, like if you to bring a date home to your parents. Yeah, that's not these stocks. These are not those stocks.
These are nice, safe stocks that you marry and you stay with and have kids with and grandkids, and you just keep them forever.
Yeah, I'm sure those, ExxonMobil executives are great marriage material. Put them right up there with Hollywood.
But what you do get with these, you get dividends that come every month or bi-monthly or annually or annually, depending on what this company is. And they just keep coming in and rolling in and building up. And eventually you just quit your job because you got enough dividends to just live off them.
So like a sugar daddy.
It's your sugar daddy.
Ouch.
It just takes 20 years to get that sugar daddy.
All right, so we've had some, haven't we had some people requested that we look at stocks? So we wanted to look at those and then ultimately what we decided to buy this month, right?
That we did.
We did. We had 2 viewer recommendations this month. So bring on the spreadsheet. We do it every month. Here's the spreadsheet. The spreadsheet has, usually 15 stocks on it or something like that. So this month, same number, 15 stocks. And if you take a look here, 2 of the recommendations, you look on the left-hand side, you'll see that there are a number of stocks in red. Those stocks are the ones we are talking about now. The ones that are not in red, we covered them, we looked at them, we researched them, but they didn't make the cut. So we're not going to talk about them. So the first one was Punished Just again. Thank you.
Punished Just. I think we were saying it wrong in the last video.
Was it?
We're like Punished Just is J-U-S. Punished Just. Tell us how to actually pronounce that.
Okay.
Anyway.
Yeah, I don't know.
He recommended one of them on our list. VICI. This is a real estate, like hospitality. This is a company that does, basically it's like an REIT, except it's more in the gaming space, gambling space, hospitality space. They got like 60,000 hotels.
MGM and a couple Vegas hotels, yeah.
They are actually, as far as the finances go, if you look at the spreadsheet, compare their numbers to all the other ones and net revenue and just the trailing earnings and everything, they look pretty good.
Yeah.
This is a healthy company. The problem is they're pretty volatile, and the Fed said that they are done raising rates, we're very positive. I am very positive about that. The problem is because the rates are still high, the effects of those rates have not been felt yet.
Right.
So until the Fed indicates that they're going to either lower rates or we see some GDP number changes, real estate still is not done bleeding.
Hopefully sometime next year, 2024, we'll see a rate cut. They haven't really said they're going to do it. They could raise them again. But if they cut them, then there's going to be a couple months to follow. But I think the REIT space is going to be one to get into.
I thought it was funny when they said, okay, we're done raising rates, and the stock goes way up. Like the stocks go way up. And then like the very next day, somebody asked the Fed, so when you cutting the rates? It's like, we're not going to do that yet.
We never said that.
And then the stocks go down again.
Raising them.
Like that's not how any of this works. For REITs, I personally have 3 REITs in my portfolio, and I want to buy them. We're waiting. I'm waiting for those numbers and the bleeding to stop, and the bleeding will stop when we know the finances. A lot of times we do a lot of research on these companies, and what we see in the articles and what we see in the research is different than what the financial reports show. So for the reason of the Fed not being to the point where they're lowering rates and where the real estate market is, with VICI, we're out. But if you have VICI right now, you can hold on to them and you're going to do fine. The numbers look okay. The other viewer recommendation that we had was, what's the name?
It was Ben Club 4408.
Yes, thank you, Ben.
Ben Club.
So this one is ASR. Now, this one did not pass the smell test on our spreadsheet. So we're going to change the channel a little bit, and we're going to try to modify If they want more in-depth on individual stocks, we're going to create, if you look at the bottom left of the spreadsheet, we're going to take a viewer recommendation and cover these stocks individually so you can know the basics, like who is the company, what do they do, what's their competition, what's the finances look like, and as of that specific stock sits right now, would we buy them or not?
And right as it sits, when we put it on our spreadsheet, we put it on there, and if we say it's good or not, usually it's not. We don't really go in depth, and I think it's doing a disservice to the person who actually asked for it, and we're getting more and more of these. So I think it really does warrant its own video, so we can do the due diligence for you.
So in the case of ASR, there's a few things in there. Their earnings per share are way in the wrong direction. They are not in a good place right now.
Right.
So what we're doing with that one is because of how volatile that stock is, and because it's an airport-based company. I mean, this is a company that does a lot of stuff down in South America, Mexico area. The volatility by itself, though, was the red flag that we decided, hey, we're going to wait on this one. When it's a company that's volatile like that, but the numbers still look okay, the best thing that I've noticed over the past 20 years is you just wait. You know, you just sit on it till you understand what's happening better.
Right.
Keep it on your spreadsheet, keep it on your radar, and then come back after a few months. Because it's not like the companies are going away. It's just right now, the time may not be a good time to buy. So you just come back in a month or two, check it again, see what happens. And then if it looks good, you understand more, and then you're good. So for right now, compared to the other stocks on this list, we decided no.
Yeah, and if you look at it, just recently it took a nosedive and then shot right up.
Way back up.
Like way up to its 52-week high. So, and we did not do a lot of due diligence to go deep into that to figure out why that's happening. That would be a separate video, but that is one red flag that you want to look at. What's happening there? What's the trading like?
Yeah, and remember,
and if I might,
go ahead.
I wanted to put a plug in here real quick to that. We are planning on doing deeper dives into other like stocks and companies and stuff in the future, and do a bit of roasting here in the future. So you can look forward to that.
I'm a little nervous about that. Yeah, I'm a little nervous about that, but we'll do it. Hopefully some executive doesn't hire a hitman on me at some point. Like, what did he say about us? Get that guy. No, whoa, and that's not what we're doing. Yeah, so that's the, we are going to dig into these a little bit more deeply, but this spreadsheet is based on the Dividend Dudes methodology of buying stocks. And there's a method to this madness that has worked for Brian and I personally in our own lives. So what we did to earn passive income is being reflected in this. Now, this is still like what, month 21?
21, yep.
Yeah, this is like not the exciting time. The exciting time comes after a few years of this and they start compounding, that snowball. Everybody talks about the dividend snowball. It really happens.
Month 221.
Yeah, it really happens. So this versus what somebody would buy on their own personal portfolio, we're going to have to separate those out. But for the ASR and VICI, there you go. They don't meet the dividend dues portfolio, but that doesn't mean necessarily that they won't be good for yours. So we'll start covering that stuff more individually. Keep the recommendations coming. Thank you for that.
Absolutely.
So next on our list, we had, I want to, it's...
RTX?
So, not yet. So we've talked, and you know that we've talked a lot about the credit debt. Like apparently consumers, 61% of shoppers in the United States are putting their holiday purchases on credit cards.
Credit card debt has reached $1 trillion for the first time.
It's record highs. Why are you doing that, people? Stop doing that. So we thought, hey, if that's happening, it's a great idea. Maybe we'll look at Visa and MasterCard.
It was a good idea.
It was a good idea until we looked at the, all the finances and ticker symbols, and they're trading at not just near the record, they're trading at the record high. So we're late to the party.
Right.
So for that reason.
Now, unless you think it's going to shatter its ceiling and just keep going up and create new record highs, we don't like that. We like record lows and then have it go up from there, because at least we know there's growth.
There is one exception to these two guys, is that they pay a relatively low dividend. So as far as a growth stock goes in a naturally inflating economy, they have the most potential to keep going up. If a company pays a high dividend, we talk about this all the time, the growth potential is lower, but these guys do not pay a huge dividend, so you could buy them even though they're trading at the record high, and given enough time, probably be okay. But right now, for this portfolio, They're not beaten up enough.
Right. And I kind of want to see the default ratio to see how many people are actually going to default on their MasterCard Visa purchases.
Yeah, that's the other thing too, is just because the credit card debt is high does not mean people are going to actually pay on those debts. Some of them might claim bankruptcy, or they might just pay it all off at once. So all that wonderful interest you thought you were going to get in income, it may not be there.
Right.
So that's the other side of that. So, which then gets me into RTX.
Ooh, another defense contractor.
War
is coming.
You sound so like this
I'm
is
into it.
this
Let's
is
do it.
So RTX is, we have General Dynamics in our portfolio, and I know we've seen all these news articles about the shortage of munition supplies in Europe because of the war in Ukraine and what's going on in Israel right now. So macroeconomically, it looked like, and I thought, hey, they're going to have to improve a defense budget. That was approved this week, though. So the current administration did approve an $800 billion package for defense spending, and that should show up as a reflection in RTX's profit at some point. The problem is when you look at these numbers, we jumped the gun. They're not there yet. So I thought, I did all this research too. I was like, you guys know, there's like how many articles? It's like just a scroll of just me. It was almost too much. Like, who does that? What's wrong with me?
We don't have time. That's a whole nother series of videos. There's a lot wrong with you. That's what I'm trying to say.
Ouch. I love you too, man.
Hey, I love you. I love you, bro.
But this RTX company, it seemed like a good deal because you need to replenish those supplies. I would love to live in a world where governments do not have to spend trillions of dollars on nuclear warheads and ammunition, but we're not there yet. So I thought it was going to be a good buy, but when we finally pulled up all the numbers, they were like the bottom of the barrel. They're the worst on the whole list. Like, wait a minute, what happened? So we did not buy them. The companies that we bought this month are boring. Tell me if they're boring. These are not boring? You don't think these are boring?
I don't think they're boring. I mean, everything's brought to you by Pfizer. Come on.
Even the cure for COVID, I guess. But
there's no cure for COVID.
So this month we bought in our wonderful portfolio, we bought ExxonMobil. We already have Chevron. The reason why we bought ExxonMobil over Chevron is, I mean, you said it best, their 52-week low, they were closer to that, and their numbers, profitability, and the finances as shown not just on their spreadsheet, but if you look at, go to any account, E-Trade, Robinhood, go to Simply Wall Street, they show that these numbers look amazing. So not only are they trading to their low, they've got a lot of profit coming in.
Oh yeah.
OPEC is nervous right now. Oil production is a problem. We know that the oil rates are not where they should be for profitability in these companies, but as far as like the stock price goes and your cost basis for that dividend, even Chevron is at a great place right now, but they're just not quite as good as ExxonMobil, so we decided to buy them instead of Chevron. For our portfolio, we do not go more than too deep into a sector, so we're stuck with Chevron and ExxonMobil until something better comes up. The other one we bought was Pfizer, and this was weighted in our portfolio relatively heavy, so we bought less of Pfizer this month. But the reason why we bought them, you're gonna think this is crazy. This might not be like the most exciting reason because we covered Pfizer before. The reason why we're buying them again is because they came out this report saying, hey, we're not going to make as much money on COVID vaccines this time as we were before, and the stock just got destroyed. They made a purchase of another, they made an acquisition of another company as well.
52 billion, I think.
Yeah, something like that.
Billion.
And there were some lawsuits going in there. The pharmaceuticals always have lawsuits.
Yeah.
There's always something. But these guys, as far as like their earnings go, look at their net income over 5 years. It's amazing comparatively. Right. I mean, if you look right here and you say, net income 5 years, it's almost up twice. It's almost 200%. So even with all of the craziness of the pandemic and everything that happened, despite all of that, and despite their short-term quarterly cash flows, like short-term, these guys are like, whoa, this does not look good. But long-term, macroeconomically, if you're looking for that passive income where you work for your money once and it works for you over and over and over again, Pfizer's not going anywhere.
Right. You always have to follow the money, and especially with us, because some stocks will say there's a scandal or lawsuit or something that looks bad and they're going to get killed, and we say don't buy it because their numbers don't look good. Their operating income is not looking good. They're not making money, or their cash flow's gone, or something looks terrible with that. But with Pfizer, even though they're getting sued, which happens to them a lot, but this is a big one. It's a big one for COVID. But
And this is a positive thing.
it's a positive thing. They're used to this. Their numbers still look great, and I think there was a panic sell because, or maybe moral sell.
I mean, it almost sounds like you're saying like, we don't always buy stocks, but when we do, we make sure their legal team can take anything you throw at them.
Exactly. They got to be weathered,
The thing
battle hardened.
The thing with Pfizer is they have a product basis that's a need. It's
Right.
not something that's a want. These people that produce these products, even though it's an evil giant pharmaceutical company, just like the evil giant oil company in ExxonMobil, they
Keep
have,
them sick. That's what I say.
I mean, Pfizer has to have products that actually genuinely benefit people. So in that case, the company is going through a rough patch right now, but I don't think that over the course of a investor mindset, not a options or a day trader guy,
Right.
an investor mindset,
And long-term investor.
this is a good play for us right now. This is how Brian and I have made our money. It just takes a long time. Now, it's very consistent though, and we think that ExxonMobil and Pfizer this month for month 21 are a very consistent play with what we've done in the past.
Yep.
That said,
So we split it up 1,500 to Pfizer, 2,000 to Exxon. So we've been going over a lot of the stocks and kind of a high level of why we purchase these. Do you guys have any questions on some of the deep dive stuff? Because we go into a lot of numbers to look at this stuff, but we don't show you here because it's frankly boring. I don't think everybody wants to see it. But if you want to see it, comment below and let us know, and we'll add that stuff to our videos.
yeah, if you have specific questions about how did we come to this decision, we can certainly make a video on that, and I think that'll help people. A lot of times there's a lot of nerd up here, and sometimes that gets lost in the translation of like, well, why did he buy this one? But if you look at our portfolio, the numbers speak for itself. I mean, it's going up a lot, and it does that very consistently. Even when the market's down, we tend to do okay. So there is a reason for that.
We're up to 32,000 into the actual portfolio. We're getting $65 a month, roughly, in dividends. So it just keeps going up.
Until it doesn't. And we
Until
all
it doesn't.
die.
Then we have different problems.
Yeah, no, it'll be fine. We're going to be fine. All right, with that, thank you for watching. See you next time.